Alright my friends, let's have an honest moment, shall we? Remember the last video when we talked about market dips being normal? Yeah, the market has decided to give us another little reminder and went down again. And you know what? That's perfectly okay. I'll tell you more. I am excited.
Oh, really?
Hi, it's Mike. Welcome back. Today we're not going to sugarcoat anything. Today we're looking into the reality of the market. And the reality is, it all went down. You might be checking your portfolio and seeing some red. That's okay, mine is red too. Let's go and see.
Here is my spreadsheet where I track my investments. As you can see, I switched from buying monthly to buying weekly as soon as the money hit my account. I explained the rationale in my previous video, I won't go into details here. There I also explained why I increased my weekly contributions from $100 a week to $130 a week. The interesting part is here, where I compare the portfolio's performance with S&P 500 index. And here we can see that even though the index plunged almost 8% down comparing to the starting point back in September, the performance of my portfolio is still positive. Less than 1%, but positive. I'm still beating the S&P 500 index. However, this performance or rate of return doesn't reflect the actual gain. Those are different things. To make it plain simple, the rate of return is like how much it would grow if I invested the whole amount at once at the beginning of the period. Then the answer is plus 0.9%. But that is if I bought all of HXS for the price of $75.04, all of ZNQ for $18.99, and all of VDY for $46.51. But that's not the case. I purchased most of my shares for much higher prices. I have calculated how the overall gain was changing these months, and I'll show it to you in a separate table. Here's the table, and here is the actual gain. So yes, I'm down almost 8.5%. There's also a couple graphs that I added. This one shows the value of my portfolio comparing to the contributions. And you can see how the values curve dived deep under its counterpart. The second graph is the overall gain in percents. It was all nice and shiny until it was not.
So here it is. Since I started investing back in August, the market has definitely taken a bit of a tumble. Everything is down, and yes, on paper I sort of lost money. But there is a magic word, in fact two words, that separate seasoned investors from those who hit the panic button and sell at the worst time ever. The words are unrealized loss. Unrealized loss or a paper loss occurs when the value of an investment decreases below its purchase price, but the investment hasn't been sold, so the loss isn't yet realized. Think of it like this. If you bought a house for $300,000 and a couple of years later the price went down and now it's worth $280,000, did you actually lose $20,000? No, it's the price of the house depreciated until you sell the house. If you hasn't and you hold on to it for a few more years, the price recovers, goes back up, and you haven't lost any money. It's the same with our shares and ETFs. Until we sell, this is unrealized loss. The value has temporarily gone down, but it doesn't mean a permanent loss. Now, I know seeing the red in your portfolio can be a little unnerving. I've been there, I am there, but it doesn't scare me a bit. On the opposite, I'm excited. And you know why?
No. Why?
Think about this. We are relatively early in our investment journey. I'm just a few months in it. The market is giving us a fantastic opportunity to buy good ETFs or shares for lower prices. Just look at this graph. I don't know about you, but I definitely had these thoughts. Those lucky bastards who managed to buy at this dip. But you know what? At that moment, their dip looked like this. Doesn't that look scary? Doesn't that look familiar? Don't you realize we are those exact lucky bastards who have the opportunity to buy this dip? I personally am not stopping. I keep dollar cost averaging in my favorite 3 ETFs, now with a huge discount. This is all part of the process, my friends. These downturns are not the end of the world, they are normal and healthy part of the market cycle. And for those of us who are here for the long term, they are opportunities disguised as challenges. Look closer. If you're looking at your portfolio and seeing red and feeling nervous, take a deep breath. Remember what unrealized loss is. Remember that consistency is key and you are here for the long run. And remember, we are buying for the future, not for the next week's headlines. I'm sticking to my plan. I'm buying my favorite 3 ETFs, check them out here, at these fantastic lower prices. If you haven't started your investment journey yet, now is the time. Now you are in the better position than I was back in September, when I was buying ZNQ at $92, $96, even $100 per share. It's below 80 right now. I envy you. Well, I'm buying. If you don't know where or how to start, I have just the right video for you. Check it out. If you think you're not ready yet or you can't afford it, I have another video. Check it out, it can change your mind. Hit subscribe to follow my journey in real life. I'll show you everything, real time, real money. Let me know in the comments below what you are thinking about this dip. Let's support each other. Stay strong, stay the course, and I'll see you in the next video.